Are we sliding into a recession? The same rule has everyone in a tizzy, with unemployment creeping up to 4.3% and some rather unimpressive ADP and non-farm payroll numbers. Before the same rule sets off alarm bells, I gave a quick rundown on it in our Dxpert podcast and why traders should take note of it. Hey there, I'm Jun, a researcher at Dxpert. The Fed might be downplaying recession fears, but are we actually on that path? Let's dive in and find out. Remember when Fed Chair Jerome Powell said that an unexpected weakening in the labor market would prompt a rate cut? Well, it looks like that moment has arrived. The US unemployment rate shot up 4.3% in July, surpassing the FOMC's June prediction of 4.0% by year-end. Adding to the drama, non-farm payrolls only grew by 114,000 jobs, falling short of expectations and down from 179,000 previously. This unexpected report has fueled market speculation that the Fed will begin its easing cycle soon, with some even anticipating a bold 50 basis points cut at the September meeting. The rise in the unemployment rate is so significant that the 3-month moving average is now 0.53 percentage points above its 12-month minimum, crossing the 0.5-point gap that triggers the same rule for identifying a recession. No wonder investors and traders are starting to panic. But should you? Let's dive deeper into some micro-employment data. July's unemployment rate surpassed the same rule threshold, raising a critical question. Will the unemployment rate continue its upward trend as it has historically after crossing this point? Typically, once this indicator exceeds 0.5 percentage points, the unemployment rate continues to rise by at least another 1.9 to 2 percentage points. It is likely that this trend will persist. However, some analysts argue that this time might be different. They propose that if the increase in unemployment is due to a surge in immigration, the rate could decrease as the economy integrates these new arrivals. Despite this, the labor market ability to absorb new immigrants seems to be weakening, potentially extending the time needed for their integration. Forecast predicts the unemployment rate will rise from 4.3% in July to 4.5% by the end of the year and continue to climb to 5% next year. The unemployment rate among newly arrived immigrants is significantly higher than that of other workers. In the second quarter of 2024, the non-seasonally adjusted 3-month moving average unemployment rate was 9.9%, compared to 3.9% for other foreign-born workers and 3.8% for native-born workers. Moreover, the rate for newly arrived immigrants has been increasing rapidly, reaching 11.1% in June. While new immigrant skills match the needs of industry with labor shortage during the pandemic, these industries no longer require as many workers. It will take time for new immigrants to gain the necessary training for other sectors still experiencing shortages. The pace at which new immigrants are integrated into the labor market significantly affects the national unemployment rate, and data from the past 6 months indicate that this integration is slowing down. Recent analysis of layoff notifications and state-level unemployment data also shows that labor market cooling has extended beyond California to other key Sun Belt states, which were significant drivers of job growth as recently as last year. The rise in layoff, now more widespread across various industries and states, is contributing to the upward trend in unemployment. In July, absence from work due to bad weather surged to 1.089 million, a sharp increase from 206,000 in June and just 164,000 in July of the previous year. This spike coincides with Hurricane Beryl making landfall on the central coast of Texas on July 8th, right in the middle of the reference period for both household and establishment surveys. While some reports blame the rise in unemployment on the storm, the reality is that the industries driving the payroll decline aren't typically affected by extreme weather. The labor market has been cooling since mid-2023, and we believe July's weak report is a clear sign that we have entered the more intense phase of this slowdown, with the unemployment rate likely to keep climbing from here. Given the weak jobs market, it's natural to wonder if the US is on the brink of a recession, as suggested by the same rule. However, situation isn't entirely clear-cut. The ISM Services PMI rebounded in July to 51.4 from a weak 48.8 in June, indicating a modest return to growth. Despite this improvement, commentary in the report suggests that US businesses are still grappling with flat activity due to high interest rates and elevated input costs. This points to the Federal Reserve policy stance continuing to constrain economic activity, even as certain sectors struggle with persistent inflation pressures. A sharp rebound in business activities, moving solidly back into expansionary territory, 54.5 versus 49.6 previously, helped lift the headline figures. Additionally, new orders, a forward-looking indicator of business demand, rose to 52.4 from 47.3, signaling potential future growth. While the economy shows signs of slowing, these indicators suggest it remains relatively healthy for now, making the question of an imminent recession more complex. The labour market cooling may be concerning, but the broader economic picture still shows resilience. Another key indicator of a potential recession is an inverted yield curve, which has been a topic of concern since July 2022. When the yield on the 2-year Treasury notes passes that of the 10-year Treasury note, this inversion is significant because it often signals an impending recession as investors demand high yields for shorter-term debt, reflecting worries about future economic growth. Yet, despite these classic warning signs, a recession has yet to materialize, defying historical expectations. One more traditional measure of a recession is 2 consecutive quarters of negative real GDP growth. However, forecasts suggest that the coming quarters will remain positive, with growth expected to pick up again in 2025. So, whether the SAM rule will succeed in predicting a recession remains an open question. The situation is still unfolding, and we will have to wait and see if this time is truly different. By digging deeper into the jobs market and various recession indicators, we have uncovered a much clearer picture on what's really going on, because let's face it, relying on just one piece of data can lead to some pretty wild conclusions. Sure, the US economy is slowing down, but that high unemployment rate, it might be more about fiscal policy and some one-off events than anything else. Curious about how this could shake up the markets? Stick around for the next episode, where I'll break it all down for you. Thanks for tuning in. I hope you found today's video insightful. Everything I've shared comes from a mix of research and my own perspective. Remember, when it comes to trading or investing, always do your own homework and stay aware of the risks. If you enjoyed this video and found it helpful, please subscribe, share, and hit the like button. You can quickly access to all our channels by scanning the QR code. Take care, and I'll catch you in the next episode.